That's what Ted takes to go to Hawaii. Does that make sense? I kind of rushed through that, you guys, so you give me yellow, something's not fair, okay? We're glad to go slowly. Okay? Don't worry about joint ventures. Okay? A limited partnership, all but the general partner have limited liabilities. Okay. All right, a non-cash asset. Investment partnerships are recorded, their fair market value, so it's the fair market value that matters when you invest in a partnership, an asset in a partnership.
Can I ask
Sure.
what the carrying value is? Because I've seen it, is that the salvage value?
No, now, the deal is, the salvage value, no, the salvage value and the residual value, that's what you expect to get for it when you sell it.
Okay.
And it's used in calculating your estimation of depreciation, right?
Right.
Now, carrying value is the same as book value, and let me give you an example. So,
Okay.
on the balance sheet, and I appreciate your question. So on the balance sheet, on the asset section, we'll just have, let's say we have auto,
Mhm.
and let's say you pay $20,000 for the auto, and you have less, and I'm going to abbreviate here, accumulated depreciation of $5,000. That means you have $15,000, and this is the carrying value, it's the book value, it's how much is left to depreciate.
Okay, so that's, okay. Is that considered the depreciable? No.
So now, here's the depreciable cost. What you have is you have cost minus, and you can call it, one name for it is salvage, S-A-L-V-H, salvage value. It's also called residual value, but it's your estimation of what you get for it at the end of its useful life.
Okay.
This equals how much you expect it to depreciate over its useful life.
Okay. So that's the depreciable cost.
And that's the depreciable cost.
Cost minus salvage.
Exactly.
Carrying value is book value minus accumulated depreciation.
How cost minus accumulated
Okay.
depreciation.
Okay.
Carrying value and book value are the same thing. And it's cost minus accumulated depreciation.
Okay.
Okay.
Thank you.
Oh, sure. All right. Okay. All right, and then one more. A partner invests into a partnership, a building worth $25,000, a carrying value of 40. Carrying value, 40,000 fair market value. The related mortgage is 12,500 is assumed by the partnership. As a result of investment, the partner's capital account will be credited for the net value. So it will be the market value minus the mortgage. So it'll be 40,000 minus 12,500. So in this case, it'll be the 40,000 minus 12,500. So that comes to 27,500. Okay. Is doing good? We have, yeah, Addie?
Can you explain something to me? The copyright and the patent. In the book, it says that patents are, the federal government does this for inventions of new technology. The copyrights are for exclusive rights to musical, literary, and artistic work. But on 22, you said the copyright was for the computer program.
Yeah.
So can you explain that to me?
It's kind of, what it is computer programs are copyrighted. And of course, it makes sense because they're certainly right? And what gets patented are things like machines, plants get patented, and then, yeah. What is designs? Yeah. They would be copyrighted. I think those would be copyrighted. But I'm not, so I think what you have to know, just kind of memorize what gets copyrighted and what gets patented, I think at this point. Now, both of them are intangible assets. You have exclusive rights for whatever gets copyrighted or patented. And computer programs are copyrighted, I suppose, yeah. And that makes sense, because they're certainly right. And of course, a patent is something that, like a machine.
It's built.
Because it's like a patent claim has an extension, more or less, in the copyright on the program or whatever. That's just the program is code that's performing,
Oh, okay.
written as code.
And then my other question is for the carrying value. I thought we always, even if we're going into another business venture, we always carry that book value with it, not the fair market.
It's the
No.
market value, it's all that
The
matters.
market of that. So So even if we bought it for 25,000, but the market value is 40,000 and we go into the partnership, we would always go with the 40,000, not what we paid for it.
Another way of saying that is the book value is a concern for the old company, the market value is a concern for the new company. All right, now what we didn't cover, let's just cover, I'll put this here, put this here, put this here. All right, so just a couple things we can touch on here. Don't forget, when you admit a partner, the money that's paid between two private individuals is not a partnership concern. What is a partnership concern is whether, is how is the capital that changes hands. In this case, I think the two parties paid an amount different than 330, but this is the partnership capital. And this one, I think it was given, okay? Here's what it looks like when the cash equals the partner. What this does, this person invests this amount of cash, and it equals their share of the partnership. If the cash is less than the share, then it's a bonus to the, in this case, they're withdrawing. So this partner takes out this amount of cash, gives up this amount of equity, that's a bonus to the remaining partners. Okay? When the withdrawing partner takes equipment with them, here's how much the accumulated depreciation was, here's how much they paid for it, here's the equity that's taken out of the business, the capital equity, then it's a bonus to, in this case, because as plug figures, it will be then, it will have the equity minus what's taken out, and that will give then a bonus, then a bonus to the old partners is calculated that way. Does that make sense?
Yeah.
You guys just did the homework, so. And I know I'm kind of rushing through here, I just want to make sure I get everything done.
Is there an acronym for being able to recall, you know, it's, do you have anything like that?
No, I don't. I didn't, yeah, I mean, sort of like in the
Just to keep it
mind.
straight, because it's like when you have the equity return on a partner versus, you know, what's the other one? Return on equity versus return on income credit to a partner. And so it's like, the formulas are similar, but it's just trying to keep everything straight.
Return on equity versus what?
So if you have an income credit to a partner, so you have the net
Yeah.
income,
There's return, there are actually two different things. So return on equity, now, if I understand you correctly, what you're doing is you're saying, I have this amount of investment. How much of a return am I making? And you compare net income to equity,
would be net income
over equity, and that's
divided
what
by
sort of,
beginning
well, that'll
and
just give you
ending
the
balance divided
percentage
by
of
2.
return.
That's the one that's beginning balance and ending balance divided by 2.
Mm-hmm.
Okay.
You guys, should we take a 10-minute break so everybody's fresh? We start in 10 minutes, you guys shine. Okay? All right. I'm behind you here.